So would you like to know where the stock market is going to be by the end of 2024? We all would. I don't have a crystal ball, but I can make an educated guess. Be back in just a second. Everybody wants to know what the stock market is going to do moving forward. Where are we going to be at the end of 2024? We've got a lot in front of us. We've got an election, we've got inflation, we've got the Fed, we've got earnings, we've got the economy. How do you digest all of this information and come up with a strategy from a probability standpoint that gives you a better chance of success moving forward? The reality is nobody has a crystal ball. But what we can do is look at probabilities moving forward. So let's start with the Fed. The probability that the Fed cuts rates somewhere between now and the end of the year currently is pretty high. The economy is slowing down. Inflation is starting to stabilize a bit, kind of teetering. And then also we're in an election year. So I would say that the probability that the Fed cuts rates a little bit between now and the end of the year, right now we're talking September, is potentially pretty high. But how does that reflect to the market? The market is already expecting the Fed to cut rates. So your concern should be if the Fed doesn't cut rates. Right now, the pricing is in for the Fed cutting rates. So if you assume the Fed's going to cut rates, you're good. If the Fed doesn't cut rates, you're potentially bad. What about the election? How much is that likely to affect the stock market moving forward? Well, it depends. It's really a change in policy, not necessarily financial policy. But if you take a look at everything that's already baked into the economy, we're already set, in my opinion, for a recession. It doesn't really matter who's president moving forward. The question is, do we get a slowdown in the economy? Most likely. Do we get a recession? Most likely. Is that a bad thing? Well, it depends on how you're invested. Economies go up and they go down. They aren't always good. They aren't always bad. We have expansionary scenarios where markets are going up or the economy is going up. We have scenarios where it comes back down. We have to be very, very careful. So I would say that we've been in an expansionary period in the economy for a long, long period of time. So now we probably have a period where the economy contracts or pulls back. That's not necessarily a bad thing, but it depends on how you're invested. What about interest rates? Interest rates went very, very high because inflation was very, very high and going up. Are interest rates likely to come down? Yes. How much will that help the stock market? We don't know. So prepare yourself in your personal economy, in your portfolio. Understand how your investments are likely to react to the economy moving forward, the markets moving forward. Is there likely to be a recession? I would say yes. That would not be crazy. It wouldn't be weird. It's been a long time since we've had a recession. Is it likely that the economy is going to contract, again, a recession? I'd say yes. It's been expanding for a long period of time. Is it likely that the stock market is going to react to that? Yes. Is it likely it will react negatively? Probably, because it's been doing so well for so long. Just look at stock market history over time. We all know it doesn't always go up. We all know it doesn't always go down. But we all know if we're not active in management of our portfolios, we're just going to settle for the ups and downs and take the average over time. What if you had an investment philosophy and you worked with advisors that took a look at your portfolio, took a look at the economy, took a look at probabilities moving forward, and helped you make informed decisions moving forward? Again, there's no crystal ball, but what if you could be more successful moving forward with less volatility in markets, meaning if you could get a higher average rate of return net of what somebody would charge you, you might be interested in that. If you can not only get a higher average rate of return, but also reduce the amount of risk you were taking to get that return, obviously, if you're in retirement or close to it, you might be interested in that. The only way to find out whether that might be a benefit to you would be to sit down with a true fiduciary, let them do an analysis of your current portfolio, let them build out a truly comprehensive financial plan for you and help you make informed decisions. Decide for yourself whether working with a fiduciary is in your best benefit or managing your portfolio on your own is in your best benefit. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.